Hey everybody, it's Ryan Mallory here, and we are going to do a stock market update. It was a peculiar week in the market. You had the S&P 500 rise for a third straight week. You had the Nasdaq actually go lower. You had the Russell continue to alternate for the last 7 weeks between up, down, and down. And you also had the Dow that went up for a third straight week. So what gives? What are we looking at here in the stock market? We're going to get into that. We're going to get into the FANG stocks, and we're going to get into some individual trade setups as well. So let's get right into it now. One of the more interesting things I've seen on the S&P 500 this past week is the doji candles that have been popping up. Last 3 days we've been seeing them here. And for those who don't know, a doji candle is basically where your opening price and your closing price are pretty much right in line with each other. We've seen it the last 3 days. Now what's interesting about that is that we've seen the doji candles pop up also prior to market sell-off. So does that mean it's going to sell off next week? No, it doesn't necessarily mean that. It just means that you should be aware of the increased potential for that to happen. You also got that in late February before we had the huge market correction. So again, we're not even trading below the 5-day moving average on the S&P 500 yet. However, still be a little bit guarded as you start seeing some of these warning signs pop up, along with some bearish divergences that we're going to get into as well. Another interesting thing that nobody's really talking about is all the broken trend lines on the S&P 500. Over time, very steep trend lines tend to flatten out some, so that may be what we're seeing here. However, it's worth noting, you have this first trend line off of the March lows, it connects with the lows from May, and then it gets broken. There have been multiple trend lines that have broken, but the most interesting one is the one that broke the June lows. Because since then, all we have been doing is trading right underneath it. It's provided a layer of resistance that is keeping the market from really exploding higher. Now I also want to show you these two boxes that we're trading in right now. We had one back in April and early May. It led to a break higher, which has also led to another box that we're trading in. So it's like we're just doing all this box trading. Now it could be that with us trading at the higher end, it is poised to break higher and test the all-time highs on the S&P 500. That would be amazing if we did, considering where we were at back on March 23rd, the lows that we were striking, for us to already be back at all-time highs. Market's never seen anything like that before. Now there's also the flip side to it, to where it provides guidance to, if we break below this box, which would be about 298 on SPY. If we break below that box, then there's a lot more downside to come. You could definitely see a retraction down to the 275 level. But in order to get a sell-off, you need volume. If you look at every sell-off that we've had volume. The one exception was probably on Thursday. We just did not have any volume with that sell-off. But what did it do on Friday? It bounced back up because there was no conviction to that sell-off. A sell-off with conviction needs volume. We're extremely overbought on all the indices right now. And yet we've been stuck in a range basically since June. So now while the odds would point to, if there's going to be a break, it's probably going to be higher, you still have to be careful about the possibility of a break lower below that box. Now if we do end up breaking out to the upside, what are we looking for immediately? Well, we're going to fill this gap here going back to February. That's the big gap everybody has its eyes on. If it can push past that gap, then we're going to probably retest the all-time highs and probably break right through them. So if the bears are going to sustain any kind of a sell-off, it needs multi-day high levels of volume. You don't have any multi-day volume. It just doesn't happen. We saw a little bit of it back in June that led to a 188-point drop on the S&P 500. We haven't seen anything like that since. Very, very low volume. Yes, it's indicative of summer trading. You get a lot of low volume readings, but this takes the cake because the VIX, it's still over 20. And so while you have the Nasdaq hitting all-time highs, the S&P 500 on the cusp of making a move to all-time highs, you still had the VIX over 20. In fact, the last time that happened was April of 2000, which marked the top of the dot-com bubble. It was at 27. Right now, the VIX is at 25. And speaking of the VIX, let's go right to that chart. The weekly chart of the VIX is amazing. 14 out of the last 17 weeks, the VIX has moved lower. Now it's testing this 50-week moving average on the VIX. Previous time it tested it, it broke higher. Now looking at the daily, it's continued to bounce off of the 200-day moving average, but on Friday, we actually broke and closed below it. Now, yes, you could see a head fake here and it reclaimed that 200-day moving average on Monday or sometime next week. That happens. Sometimes you have a break, it gets a lot of people excited thinking that there's a further move downside, only for it to reverse course and burn a lot of people in the process. Now I talked about boxes earlier. One of the greatest boxes of all time was IWM. It was in a box going all the way back to 2019, and it finally broke out towards the tail end of 2019. But right now, price is actually creeping back into that box from 2019. Does it start trading sideways and does it start getting choppy again like what we saw last year? Very possible. Worth keeping an eye on here because there could be a lot of distribution going on with small caps as we entered into that sideways trading range going back to 2019. Now check out the Nasdaq. It actually had a down week while the Russell, the S&P 500, and the Dow all went higher. and we saw it do so on above average volume. Now, as earnings continues to roll out, if we see the same problems that we saw on Netflix with Facebook, with Amazon, with Apple, with Google and Microsoft, then you're probably going to see an even bigger correction in the Nasdaq that could pull the whole market down with it. But on the daily, you can see, yes, it finished lower on the week, but it's still kind of holding its own. It's not breaking below the 20-day moving average. The 20-day moving average continues to be an area for the index to bounce off of. So if you're looking to get long on the Nasdaq, I would wait for a retest of that 20-day moving average like what you got on Tuesday. And if it does, then try to play the bounce off the 20-day moving average. But be careful, because if you see multiple days of where it's trading below the 20-day moving average, that would probably be your sign to get out of the trade. Now, you're seeing a little bit of a rotation underway in the stock market right now, particularly with money flowing out of tech and into the small caps. Small caps are lagging the move that we've seen in tech. So it makes sense right now for us to be seeing a lot of that capital flowing out of tech, booking the profits there and putting that money into small caps. Now, this indicator here is the T2108. It provides the percentage of stocks trading above their 40-day moving average. As you can see, there's a huge divergence here. Going all the way back to early June, you're seeing less and less stocks trading above their 40-day moving average, despite the fact that the S&P 500 is trading at rally highs. That should be a huge concern for us right now, because less and less stocks are participating in this rally. That means like your FANG stocks over the last few weeks have been the ones that are dragging this market higher, even though less and less stocks are participating. When you start getting less and less participation out of stocks as a whole, that usually leads to a broader market pullback. We saw that in late February too. I was talking about it in late February, how less and less stocks are participating in the market rally, and we're seeing the same thing again. Now let's look at the FANG stocks here. First up, Facebook. Do I like this chart? Not really, because it's just trading sideways. It had a bunch of advertisers jump ship. It sold off for a couple days. It's right back to where it was. It's trading at all-time highs again. However, it's a very choppy range. There's really no true setup there. If it can break above 250, you probably have a good move on your hand. But right now at 242, I don't see a trade at this point. Amazon, it's back below 3,000. If it can continue to pull back, let's say around 2850, this would probably be a good entry point to get into Amazon. It's a little bit higher risk because of how much it's moved during the COVID crisis. It could see a broader market pullback that takes it down to like 2550. And if that happens, you have a huge support level for it to bounce off of. Now, Netflix, it actually pulled back to a significant support level here yesterday after earnings. Good chance with the 20-day moving average underneath, you're going to see some dip buyers come in next week and try to bounce this thing higher. If it doesn't though, watch the 50-day moving average, because that has been a huge catalyst for the stock to bounce off of. Apple probably has the best trend line of any stock in the market right now. It's really beautiful. It bottomed back in March and has just gone consistently higher. Oftentimes you see all the FANG stocks down, but Apple is still trading higher. It is the breadwinner of this stock market. It is amazing. You can continue to try to play it off of this rising trend line. I'm not saying that you're going to have massive gains at this point with it trading at 385. However, you could see a trade go from like 385 to 400 over the course of a week or two, and that would make for a decent return with a very tight stop loss. If I was going to put a stop loss on this trade, I would put it below the 20-day moving average. If you get a close below the 20-day moving average, that would be where I'd get out at, because it hasn't even violated it yet one time going back to early April. Google has been one of the stocks I've been the least interested in. It just doesn't excite me at all. It has these little spurts that come out of nowhere. Again, there was a Facebook issue that weighed on Google a little bit, but it bounced right back up, and now it's trading back around its all-time highs. It's a pretty solid stock. I just don't know if there's a lot of reward to justify any kind of risk. Now check out Microsoft. Maybe we're not going to see this anytime soon, but if it can pull back to 184, that's where I would try to get long at. As a huge support level going back to the February highs, I really like everything I'm seeing on this particular trade if it can pull back to that level. And if it does and you're able to get in, then I put my stop loss below the 514 lows. But here's what concerns me about Microsoft at its current price. It broke a major trend line that had held steady going all the way back to the March lows. It broke it this week. It broke the 20-day moving average, which we have not seen the likes of Apple do yet, but Microsoft has, and there's the potential that it's going to see a lot more downside, possibly down to the 184 area, which is where I would want to get long at. Now here's my favorite chart going into next week. It's going to be Twitter, TWTR. You have this massive inverse head and shoulders pattern. Yes, like Google and like Facebook, it's had some of its problems of late, but look at the consolidation right below this neckline breakout. If it breaks above it and some of the recent price action around 36.25, then I want to put my stop loss at no lower than 33.42. It's a beautiful trade setup. It's got a lot of potential here for it to go right back up into the 40s and give us a really solid reward for the amount that we're risking. As for the stock market as a whole, there's still a lot of risk in the stock market. There always is. But right now there's a ton of it. You have the COVID rate spiking. To this point, the market hasn't cared about that at all. It's ignored the COVID rates going through the roof, more shutdowns. Instead, it's looking more towards what's the next stimulus package going to be? What is the Fed going to do to continue to boost the market? It's basically on welfare right now. That's what the stock market's on. It doesn't care about earnings so much as it does about what is the Fed going to do and what kind of stimulus package is Congress going to pass. If the Fed starts pulling back, or if Congress has difficulty passing another stimulus bill, which the latter I think is very possible, you're going to see this market pull back some. Because right now, if you take away the stock market sugar daddy and the Fed or Congress, it's going to lose its marbles and it's going to come down. As long as those two things stay intact, there's a good chance S&P 500 goes back up. Also, I'd encourage you to like and subscribe to this video. You'll get the notifications of any time that I put a new video out. I'm actually thinking about going to 3 videos per week. We'll see if I have the capacity to put out those. I'm doing about 2 a week right now. I've been on vacation the last couple weeks, so you haven't seen as much from me, but I'm definitely going to be upping it back up to 2 next week. And tell me down in the comments below, what kind of trade setups are you looking for heading into the new week? Are you scaling back on your long positions? Are you getting into some more short positions? Or are you just looking to go cash? I want to hear about what you have to say down in the comments below. Thank you. God bless.